Top 10 Things You Must Know About Mutual Funds. Hi everyone, I'm Sheena, and today we're diving into something that every investor beginner or pro should understand about mutual funds. These are one of the easiest ways to get started with investing, but there's more to them than meets the eye. So let's go over 10 important things you really need to know before you put your money in. 1. What is a mutual fund? A mutual fund is basically a big pool of money collected from many investors like you and me. This money is then invested in a mix of assets like stocks, bonds, or even gold, depending on the fund's goal. The idea is simple. Instead of picking individual stocks yourself, a fund does it for you. 2. Types of mutual funds. There are many types of mutual funds, each with different objectives. Some focus on stocks, called equity funds, others on bonds or debt instruments, debt funds. Then there are hybrid funds that mix both. There are also index funds that track stock market indices. Knowing these types helps you choose one that fits your risk tolerance and goals. Diversification. Why it matters. Ever heard the saying, don't put all your eggs in one basket? Mutual funds follow that to the letter. They invest in a wide range of assets, which means if one investment doesn't perform well, others might balance it out. That's what we call diversification, and it's a big reason mutual funds are popular. 4. Professionally managed. You don't need to be a finance expert to invest in mutual funds. Each fund is managed by a professional fund manager whose job is to analyze the markets, pick investments, and manage the portfolio to meet the fund's objectives. It's like having a financial expert working for you. 5. What is NAV? Net asset value. NAV stands for net asset value. Think of it as the price of one unit of a mutual fund. It's calculated daily based on the total value of the fund's investments divided by the number of units. So if the value of the fund's holdings goes up, so does the NAV, and so does your investment value. 6. Returns are market-linked. Unlike fixed deposits or savings accounts, mutual fund returns aren't guaranteed. Since they're tied to the market, returns can fluctuate. That means there's potential for higher growth, but also some risk. The key is to stay invested for the long term. 7. Understand the costs, fees, and charges. Mutual funds aren't free. They charge an annual fee called the expense ratio, which covers management and operational costs. Some funds may also have entry or exit loads fees when you invest or withdraw. These costs can eat into your returns over time, so be sure to check them before investing. 8. SIP versus lump sum. 2 ways to invest. You can invest in mutual funds in 2 main ways. A systematic investment plan, SIP, where you invest a fixed amount regularly, or a lump sum, where you invest a large amount at once. SIPs are great for building wealth slowly and benefiting from rupee cost averaging. Lump sum can work if you have a large amount ready and the market conditions are favorable. 9. Risk levels vary. Not all mutual funds carry the same level of risk. Equity funds are generally higher risk, but also offer higher potential returns. Debt funds are lower risk and more stable, but offer modest returns. Always assess your risk appetite before choosing a fund. 10. Always match the fund to your goals. This one's key. Don't just follow trends. Choose mutual funds based on your financial goals. Are you saving for retirement, a child's education, a house in 5 years? Each goal may need a different kind of fund. Also, review a fund's past performance, fund manager experience, and the investment strategy before investing. So, there you have essential things to know before investing in mutual funds. They're powerful tools, but like any investment, they need some understanding. If you like this video, hit that like button, subscribe for more personal finance tips, and let me know in the comments which fund type you're exploring.